Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hello and welcome to another episode of the College Investor Audio Show. We're so glad you're here. Now today we're talking about state taxability of student loan forgiveness. Let's get right to it. So the American Rescue Plan Act of 2021 added an exclusion from income on federal income tax returns for student loan forgiveness through December 31st, 2025. But what about state policies for taxing student loan forgiveness? Some states provide tax-free status for student loan forgiveness and some don't. States with no income tax, there are 9 of them that provide tax-free status for student loan forgiveness because they don't have personal income tax. This includes Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. New Hampshire and Tennessee have a tax on interest and dividends, but no other income. The Tennessee tax on interest and dividends is ending in 2021. All right, now, here are some states that automatically conform with federal tax rules. There are 20 states that base their definition of income on the federal definition of adjusted gross income, AGI, from the Internal Revenue Code of 1986, as amended, and automatically update their definition with changes in federal law. We have an article on what AGI is and how you can figure it out at thecollegeinvestor.com. Accordingly, changes in federal tax law, such as the new exclusion from income for student loan forgiveness, will automatically affect state income tax in these states. There's 20 of them, and there's a list at thecollegeinvestor.com. In addition, Iowa has a subtraction for military student loan repayment. New York doesn't consider distributions from 529 plans to repay student loans to be qualified. New York has an explicit subtraction for student loan death and disability discharges. 3 states, I can name those, base their definition of income on the federal definition of taxable income instead of AGI and automatically update their definition with changes in federal law. Those 3 are Colorado, North Dakota, and Oregon. There are 11 states that base their definition of income on the federal definition of adjusted gross income, AGI, as of a specific date. So in effect, these states have decoupled their definition of income from the federal definition of income. So as such, these states must pass laws to incorporate changes in the Internal Revenue Code of 1986, or IRC for short. Not all will, but even when they do, the state laws may lag in changes in federal law by like a year or more. So one must compare the date of the version of the IRC upon which the state law is based with the date upon which the tax-free status was enacted for various student loan forgiveness and discharges. That can get confusing, I know. Accordingly, these states do not automatically include the exclusion from income for student loan forgiveness from the American Rescue Plan Act of 2021. Student loan forgiveness may be taxable in these 11 states. They include Arizona, California, Georgia, Hawaii, Indiana, Kentucky, Maine, North Carolina, Virginia, West Virginia, and Wisconsin. Sticking with California, they actually provide tax-free status for the borrower defense to repayment and closed school discharges through December 1st, 2024. California also provides tax-free status for death and disability discharges through January 1st, 2026. Public service loan forgiveness is tax-free in California. Maine provides a state income tax credit, the Opportunity Maine Tax Credit, to reimburse student loan payments for recent college graduates who live and work in Maine. Maine also provides a subtraction for student loan payments made by the borrower's employer under the Maine Educational Opportunity Program. Employer Student Loan Repayment Assistance Programs, or LRAPs, are taxable in North Carolina in 2020. Virginia excludes the total and permanent disability discharge from income on state income tax returns, but only for veterans and only through 2025. Virginia provides a subtraction from income for student loan discharges due to the student's death, It does not apply to discharges of private student loans, though. This may have been superseded by changes to federal tax law. Arizona, Virginia, and Wisconsin do not have an addition to income for student loan forgiveness and other student loan discharges. All right, now, 3 states base their definition of income on the federal definition of taxable income instead of AGI as of a specific date: Idaho, Minnesota, and South Carolina. Minnesota generally conforms with federal law concerning the taxation of student loan forgiveness. Minnesota does have a subtraction for the forgiveness after 20 to 25 years and an income-driven repayment plan, and for Minnesota teacher shortage loan forgiveness. Minnesota provides a non-refundable student loan credit for payments made on qualified student loans. That's nice. We have a table that shows the effective date of changes to the Internal Revenue Code of 1986 or Higher Education Act of 1965 to exclude certain types of student loan forgiveness from income. If you want to see the riveting chart, it's at thecollegeinvestor.com. Now we move on to, I hope this isn't losing you, by the way. I understand a lot of states and different things going on here. But here are some states that do not base income on federal tax rules. This is important if you live in these states. There are 5 of them, and they base their definition of income on their own definition of gross income. That's not confusing at all. These states do not conform with the federal definition of income, so any changes in the federal definition just doesn't affect these states. The exclusion from income for student loan forgiveness from the American Rescue Plan Act of 2021 does not apply to these states. Pay attention. These states must pass laws to exclude student loan forgiveness from income. Now, these states include Alabama, Arkansas, Mississippi, New Jersey, and Pennsylvania. Arkansas has a subtraction for interest paid on qualified education loans. New Jersey has an exclusion from income for the cancellation of debt. Pennsylvania taxes forgiveness of student loan debt for work in specific occupations. Thus, public service loan forgiveness and teacher loan forgiveness is taxable in Pennsylvania. Employer-paid student loan repayment programs, LRAPs, are taxable in Pennsylvania as well. The discharge of indebtedness is taxable in Pennsylvania unless it's specifically excluded from taxable income. Here's a disclaimer. This podcast was actually just based on a review of state income tax forms and state law. No claims are to be made here about the accuracy, timeliness, or usefulness of the information provided today. The information described may change. Everything is fluid in the government. I also have to say this podcast does not provide legal, financial, or tax advice, so it's just general in nature and may not apply to the specific circumstances of individual listeners. So, you should seek specific guidance directly from a qualified accountant or tax professional in your state if you have any questions at all. You can also check out the chart and some other resources at thecollegeinvestor.com. Phew, that was a lot of jargon to get through, but I hope it was helpful, especially if you live in one of these states mentioned. If you want to find out more, of course, once again, it's thecollegeinvestor.com.